Good afternoon, ladies and gentlemen. My name is Robert Rayburn. I am joined here by our analyst, Tim Devlin. It is March 24th, but if you are watching this, it is actually March 25th. And when we tweeted out that we were going to be sending out our presentation on the 24th, we did want to make sure that we were incorporating some of yesterday's market action into our weekly update, which is the prime reason why we are 1 day delayed as to when we are sending this out. So I hope everyone appreciates that. We certainly did not delay that on purpose. But Tim, it's certainly been a rough March. It was a rough day yesterday. And, we just continue to see this rotation from winners to losers. And Tim, what are some of the questions you're getting from clients and from advisors as we sort of wrap up what's been a pretty nasty March? It's starting to be a theme. March continues to be a weak month for Life Pro Asset Management.
Yeah. So, one of the things we're known for is total transparency, right? So whenever we're talking to clients, advisors, we show that number, hey, we're down year to date, and the S&P 500 is up. So the big conversation right now is, why are we down? Why is the S&P 500 up, right? So I think, kind of the slides we'll go through today will kind of really touch on a lot of those points and why we're kind of sticking to what's made us successful, in the past couple years, months, right?
Those are great points, Tim. And there are great questions from clients and advisors. Is that, listen, at the end of the day, we outperformed in January, we outperformed in February, but March has sucked. And the prime culprit has been this rotation from winners to losers. In other words, stocks that haven't performed well from March 2020 to March 2021 flat out have hit the ball out of the park in the month of March. How have institutional investors funded those trades? They have sold the stocks that have done remarkably well from March 2020 to March 2021. And what we're going to go through today is, has anything changed fundamentally with the individual companies that have done well over the last year? Have their stock prices been a result of, quite simply, COVID and the shutdown? Or are they part of what we call megatrends? Are they leading those megatrends? What are the state of those megatrends? And do we see any reason at this point to sort of rotate what our style of investing is all about and the types of companies that we invest in? So that'll be a big theme in this week's update. The other big thing that we're going to talk about is this quant rebalancing. Now, this is a bit more of a nuanced term. Winners to losers, that's simple enough. Quant rebalancing, what is it? One of the big factors that also played into consideration in the month of March is that we get a lot of quant funds out there that have a lot of assets under management. They do a lot of hyper day trading. And one of the key factors that they look at when making reallocations in portfolios is to say, over the last year, what are those stocks that have outperformed by 1 to 2 standard deviations relative to those stocks that have underperformed by 1 or 2 standard deviations? And sure enough, every once in a while, you do get a month that you're coming across extreme year-over-year comparisons, and March was that month. It's not like the reopening trade started in March. I mean, we had the vaccine starting to roll out in the month of November and December. We started to see the airlines pick up and the cruise lines pick up, but our big mega trend theme stayed intact. It's really been in March when you had this rebalancing take place with a lot of these quant funds where we finally got impacted, and that's what clients are seeing in their accounts. The third and the last thing, rising interest rates. When interest rates rise, even if it's from a small level to a less small level, but an absolutely cheap level, we do get that rotation that takes place in the stock market. First, bonds are sold. Second, those stocks where we get a lot of growth that are taking place in the future, it is seen that higher interest rates will discount those earnings to a lesser value when we move that to the present value. That's a little bit more nuanced, and it's kind of an excuse for the first two as to what has taken place in the market. But nevertheless, when we break down the month of March and why the month of March hasn't been kind to a lot of people that have been winners over the last year, it's these three factors. And Warren Buffett had a great quote, and that is, over the very short term, the stock market is a voting machine, but over the long term, it's a weighing machine. And the reason for that is that, in the month of March or February or April, certain stocks are going to outperform and underperform, and it'll have nothing to do with the fundamentals. But over the long term, the market actually does a really good job of discriminating between good and bad companies. And that's where we've created a lot of value, not just last year, but in 2019, 18, 17, and beyond. And we're going to stay focused on that. We're going to stay focused on the strategy that has helped deliver value to clients over the long term and to our strengths. And our strength is to be able to identify core mega trends that are taking place in the economy and those companies that are leading the charge. And we expect over the next 12 months, so we're going to go through the math, because Tim, you put together a great chart on this, but we're going to go through the math that shows clients that anytime that we've had a 7.5% drawdown, in other words, sell-off or greater, clients in our strategies have experienced a positive return 100% of the time on a 12-month forward basis. So we're going to go through all of that today. So in the month of March, if we could put it all into one picture, this would be it, ladies and gentlemen. This is the relative performance of stock prices of weak balance sheet companies minus strong balance sheet companies. When weak balance sheets lead, quite frankly, ladies and gentlemen, LPAM underperforms. The Life Pro Asset Management Tactical Opportunity Strategy is going to underperform when these bars are massively positive. And how do we know that? We can look through in history. In 2016, we had a couple weak quarters right around when we had that junk trade take place. The same thing in 2019, where we were number one amongst growth strategies in the country. And again, what we had is we did have a quarter where we underperformed. Why? Because junk led. And that's really what's happened here over the last month and a half. And the message here is we're not going to chase weak balance sheet companies with a lot of debt that have low prospects to reinvest in their business because they're servicing their debt levels. It's kind of like where the US federal government is right now, with the only exception that these companies can't print money. And so we want to make sure that we stay extremely focused on quality, on growth, and in particular, mega trends and the companies leading those mega trends.
Yeah, and Rob, I think it's important for people to understand that these are short-term trends, right? We see even when those bars go up, where weak balance sheets are winning, they revert back, right? These are not companies that are creating long-term value. Like you said, they're being forced to service their debt, and it really hampers their ability to innovate and grow their business, right?
You're 1,000% correct. And we do get a questions from clients once in a while of about this idea of mean reversion within the secular growth stocks. And what we've seen historically is that secular growth stocks do not mean revert. They continue to grow upward and to the right. What does mean revert are these cyclical stocks, right? Whether it's steel stocks, or we're talking about airlines or auto manufacturers, things that are very cyclical, boom bust in nature, those tend to be mean reverting. And Tim hit the nail right on the head when he said that a lot of these cyclical stocks are short-term moves that tend to mean revert once things start to normalize out. And it just happens to be that March is that year-over-year comparison where the hard shutdowns took place last year. We are mean reverting, as a lot of these businesses are going from a high likelihood of bankruptcy to not going bankrupt. That price reversion, or that price revision from being bankrupt to not being bankrupt, is significant. And those stocks have rallied appropriately to reflect that. What we don't expect is that they are going to lead over the next year, 2 years, 3 years in terms of high earnings growth, high free cash flow, and dominating these mega trends that ultimately deliver excess returns for clients and investors. Real quick here, in terms of the performance, as of March 23rd, we're down about 5.84%. So we continue to underperform the S&P 500 in 2021. Now, I will highlight that this is not including yesterday's action. We only publish audited results from the third party of our performance provider. So we always want to make sure those are the only numbers that we post. But yesterday we had a bad day. We were down like 4%. So these numbers are going to be lower. But when we look at the 1 year number, and I think that the 1 year number is the most important number out there, where we are up 137.08% over 1 year. In other words, leading the country across all available strategies in terms of that performance. When you have a long-term mindset, when you don't get caught up in the day-to-day trade action of the stock market, which can really, at the end of the day, throw us off kilter. And it's the same reason why on a horse we put those blinders on. Why? Because we want to stay focused, and we want to stay focused just like a laser, right? And we don't want to get distracted by noise. We want to weigh the fundamentals. And that's what we've done, not just over the last year, but over the last 3 years, over the last 4 years, and since inception. That's key. And if we look at the chart here of the tactical opportunity strategy throughout time, what we see is we really did have a very large rally from really the beginning of 2020, minus the sell-off, and then through to mid-February. We need to digest the gains, is the bottom line here. Now, we were a little bit overbought. This sell-off is a little bit more than we anticipated, but we're digesting these massive gains that we've had. When you get gains like this, ladies and gentlemen, this is not because a stock is going through a short-term trade thesis. It's because of COVID or not COVID. These are mega trends, and these are the companies leading the mega trends. And the biggest mega trend out there is the digitization of the global economy. That's not going away. That's not reverting. That's not reversing, right? What is really happening here is we're digesting those large gains before the stocks can resume their upward trend. Whether it's the stay-at-home stocks like Zoom or Peloton, do we expect that we're not going to be tapping into Zoom? We're recording on Zoom right now. We use Zoom more than ever. And so for a lot of these companies that are leading the charge in some of these digital plays, 2021 from a fundamental perspective and a cash flow perspective is going to be even better than 2020, because guess what happens during an economic recovery? Companies have more money to spend and invest in software, invest in infrastructure, invest in people. And so when we look at the guidance of these individual companies, things are getting better. When we look at a company like Peloton, what was the number one negative point on their call? It was that they didn't have the infrastructure to meet the overwhelming demand that they were getting from customers. So right now, those lead times, once you place an order on Peloton, it's like 3 or 4 months. As they invest in infrastructure, those lead times are going to compress. That cash flow drops down to the bottom line, and you'll see that stock, in our opinion, resume its upward trend. Just a couple of examples of companies that have gotten hit recently that are in the portfolio and we think are inappropriately labeled as COVID stocks. Amazon, a company we don't own, labeled a COVID stock. Last time I checked, Amazon has been in secular growth mode for the last 25 years. So it's very important, ladies and gentlemen, we don't get distracted by that short-term noise or stuff that we read in the media. Investing, I personally like my job and I personally like what I do for a living, but investing is more boring than the media leads you to believe. A lot of it is You do your due diligence, you come in the morning, you look at the stock price and you say, do I think this stock will outperform over the next 12 months versus the market and versus other available substitutes with a similar risk adjusted profile? If the answer is yes, you keep the stock. And if anything, during this sell-off, a lot of those stocks have become a lot more attractive. Now is the time you stay disciplined. If you got extra money to put to work, you put it to work. You got valuable merchandise that's deeply on sale. It's hard to sometimes communicate this to clients, but I get so excited during these sell-offs if I have any spare money lying around, because I'll put it to work. And I'm like, oh man, this stock should be here. It's here. And the fundamentals are here. I'm putting that money to work. One quick thing here in the very, very short term is that despite the painful day yesterday, we still are off the lows from early March. Now, when you get stock market corrections or investment style corrections, there's a phrase that we often follow, and that is corrections start with a bang, right? So if we think of that first sell-off, it was very noisy, high volume, lots of panic. We had a counter trend rally within the correction, right? So we retraced about 50% of that correction. And lately we've been coming back, right? And then yesterday was kind of a painful day, but it was also quiet. And what I mean by quiet is that the volume was very low. And stock market corrections start with a bang and they end with a whimper. And when we look at the individual stocks across the board, a lot of them had bad days yesterday, but are still off the lows from where we were 2 weeks ago. Could we retest the lows? Absolutely, right? Tomorrow we will probably open, tomorrow being today, if you're watching this, we probably would have opened weaker. But the key is, how do the stocks react when we get to these levels? And we'll keep everyone up to speed and whether any changes need to be made. But we expect, again, that we are in that similar story of in with a bang, out with a whimper. And that's what we're looking for here over the next couple of weeks, especially as we end the month of March. Tim, do you want to go through this chart with the audience? I think this is the single most important chart that we've put out in the last 4 years as a firm.
Yeah, so one of the things we wanted to do is look at what the return experience was for our clients that were invested in the opportunity strategy based on the time they invested, right? If they invested in a drawdown. So on the bottom axis here, you can see the extent of the drawdown had the investor invested at that time. And then what was their forward 12-month return, right? So 1 year later. And what we can see is as those drawdowns get greater and greater past 10, 15, and 20%, we can see that the forward returns are often, increased over time. And one of the things that you highlighted here that I think is really important is this light blue line, about a 7.5% drawdown. What we see is all of the clients that we've had invest in the opportunity strategy have had a positive return experience 1 year later, had they invested, greater than a negative 7.5 roughly percent drawdown. And I think that's really important, right? Because we always talk about we have to use these opportunities as a time to buy. You have to have conviction in that, right? And this helps you being able to put that data behind the numbers and look at the fundamentals of this company's. Really, this is what the return experience looks like if you're able to be disciplined and do that.
Yeah, good points, Tim. And I'm going to take it a step further. Ladies and gentlemen, this chart is so important, not just for our strategies, but investing in general. Stock market corrections or investment style corrections like growth versus value, all of that noise and junk is exactly where clients trip up. That's where institutional investors trip up. So it doesn't matter whether you're a professional investor or stay-at-home investor, this is where people trip up. And it's that noise, it's the viciousness of the sell-off that ultimately throws people off kilter. And the bottom line here is whether you're an existing client or you are a new client, when you've had a sell-off of 7.5% or greater in the LPAM tactical opportunity strategy, you've had a positive rate of return 1 year forward 100% of the time. And not only that, as the drawdown has been worse, your forward returns have become more and more attractive. Now, to us, it makes sense, right? We think of it like, duh, because you're investing at lower levels. But a lot of people will not pay attention to that during the crisis or during the sell-off itself. They're paying attention to how the account values are coming down. And this is, for us, I just think so important because, you know, anytime 7.5% or greater, you have had a positive forward rate of return. And in many cases, very attractive forward returns. We're talking in the triple digits, and a lot of these numbers were taking place over the last year or so. But even stripping out the impact of COVID, we see these forward returns between 25 and 50%. So we think of those 2018 market sell-offs, you know, those are great times to put money to work. And so whether you're investing in our strategy or you're investing with an other third-party investment manager or the stock market in general, ladies and gentlemen, this lesson can be applied across the board. Stock market corrections are moments of opportunity. They're not moments to get scared, panic, and sell at the bottom, because at the end of the day, you own valuable merchandise in the form of individual companies that are going from good to great. We want to use this in an opportunistic way. So real quick here, just a quick reminder in terms of where we are in the broader cycle. Right now, we remain in the middle innings of what we call a secular bull market, a long-term bull market that was born in 2009. COVID was that 1987 moment, that mid-cycle hiccup. All these hiccups and corrections, they all have their reasons attached to it, but the symptoms are the same. A secular bull market interrupted by cyclical bear markets that are shorter term in duration, shake people out before resuming that broader uptrend. American supremacy, 1942, the defeat of Nazism, the emergence of the US as sole superpower was the first mega trend secular bull market. Defeat of inflation in 1982, and then 2009 to present is the American resurgence and the defeat of deflation. Are we going to have hiccups during this secular bull market? Absolutely. Are we going to have style corrections, growth versus value? Absolutely. Is this going to be our last stock market correction or style correction or growth versus value or period of underperformance? No, it won't be. And as much as I would like for us to outperform every single month, we're not going to. And one of the things we say to all of our clients and all of our advisors is that when you invest in with us, I have no idea if you're going to make money, lose money in the first couple of months or outperform or underperform, but give us a year. And I think I'm very confident that you'll be very happy. And that's what we've seen. Going back to this chart right here, what does this say? For clients that are with us for 1 year or longer, at the end of the day, they have been very happy and they have been rewarded. And so, you know, we do get, this won't be the last stock market correction, the last time we have to post this chart and the last time we have to walk through a lot of these charts. And that's okay, because we have to be reminded of our discipline. We have to be reminded of our principles and what it takes to be a long-term successful investor. An investor, not a trader. Real quick here, in terms of the year two of a recovery, year two always tends to be a little bit choppier, Tim. 2009, 1982, you get these strong, everything rallies off the bottom, recoveries. And then year two is a reassessment, taking some profits, reallocating those profits. That can create noise. And we just have to stay focused. And I think one of the bear arguments of the market in general, not just our stocks, but is that, 2020 was such a huge rally, we must be near the end of the cycle. And we beg to differ. So what we did here, ladies and gentlemen, we pulled a chart from our Bloomberg terminal, and it kind of separated the last 5 first year recovery periods. And there's an interesting trend here. So the white line, the blue line, and the yellow line are the biggest rallies we've seen during the first year of the recovery. Notice the years. Obviously, we had last year, then we had 2009, in 1982. All 1982 and 2009 were the birth of new secular bull markets. The orange line, which had a good return, but it was in the middle of a secular bear market that was born during the top of 2000 and ran from 2000 to 2010. A secular bull market being, if you're invested for a decade or longer, you did not experience positive rates of return in the stock market. And 1987, which was simply just a mid-cycle correction before the resumption of the broader trend. The message here is that the strength is a sign of health. It's not a bad thing. You want to see these big rallies first year within a recovery. That's a symbol of long-term durable strength. So the fact that we had a good first year in the stock market off the COVID bottom, that's a good thing. Oh, and by the way, going back up to our performance chart here, this strategy rallying like this off the first year of a recovery, guess what? That's a symbol of strength. That's not a symbol of weakness. That's not a symbol of froth. That's a symbol of these companies are going to lead the charge most likely. And so we always say most likely because of course nothing's guaranteed, but very high level of confidence in terms of the way things are being exhibited, behaving, digesting as we get into the second year of the recovery.
And Rob, one of the things I think is interesting kind of on that chart there is if we think about that weak balance sheet chart you showed earlier,
yes,
that was 2009, right? So we saw a similar action take place right after that strong recovery back in 2009 as well, right?
Yes, absolutely. So I think it was this chart that you were speaking of. And, what led this rally right here, ladies and gentlemen? The banks, right? The banks. And what happened? The banks were at the center of the global financial storm in 2009. Guess what happened? In March of 2009, when the market bottomed, it bottomed because the Federal Reserve basically said they would not allow the banks to fail. Guess what happened? The Enfuego trade into the banks, right? The banks rallied 60 to 70% off the fact they would not go bankrupt. But guess what? If you're Citigroup trading at 99 cents at its bottom and you go to $2, that's a double. But it's way off the $80 that it was trading at. And so what did the banks do after that? Well, guess what? They did nothing for the next 10 years. They were basically dead money while we resumed a secular bull market in a lot of areas of the economy. So the message, and I think that a very strong point there made by Tim, and we need to pay attention to it, is that the Carnival cruise lines of the world, the cruise liners in general, the airlines, the restaurants, all these things that were impacted at the center of the COVID storm, they can seem attractive because those stock prices are very low relative to the companies that we own. But the message is that they survived by raising a lot of debt.
Yeah, and it's funny you mentioned that the banks back in 2008 weren't allowed to fail, right? We saw something very similar with the airlines and cruise liners, right? And the airlines were given money.
Too important to fail. Too important to fail, right? From too big to fail to too important to fail, or too convenient to fail. We need airplanes. We still need to travel, so we can't let them fail. But that's different than will they grow? Will they generate EBITDA? Will they generate cash flow? Will they grow enterprise value for investors over the next 5 years? We believe the answer is no once we get past this normalization period. And that's why it's so important that, yes, right now, financials, energy, industrials, real estate, they're leading momentum, short-term momentum, while tech, healthcare, consumer, those areas of the market, we see weakening momentum. March is obvious. We just have to look at our accounts to see that. But it's those areas of the market where the trend is the strongest. And that's what we need to pay attention to. Now, in terms of the broader economy, kind of going back to why we think this is really just the early innings of the recovery from last year, is that the only difference between the financial crisis and this crisis is the amount of money that is being pumped into the economy. In 2008, 2009, it was largely a monetary response. The Federal Reserve lowered interest rates to zero, and printed money. We did get a fiscal response of 700 billion, and a lot of that was to save the banks. This time around, we're going full in monetary support and full in fiscal support. Will that have a hangover at some point? It will. But for now, that's very, very positive as it relates to the long-term outlook for the stock market over the next 6, 12, 18 months. And so it's very hard to bet against that, even if you get noise in the very, very short term, and it can cause some distortions in terms of value to growth of value rotations and stuff like that. We got to stay focused on the big picture, ladies and gentlemen, and that's this chart here. We may not agree with the spending. We may agree with the spending. That doesn't matter. We got to remove politics from the picture. We got to stay focused on more money tends to be positive for stocks. Doesn't matter where that money's going because it's going into the system. The stimulus response, the only other time that the stimulus response has been greater for the economy has been during World War II. And I just think that's such an important thing to remember, that during World War II, we had almost 20% of GDP of fiscal stimulus. That was to fight a war. This time around, we're fighting a war, a global pandemic war, but we're also being pairing that up with a massive monetary stimulus, which we didn't have in World War II. So pound for pound, this is actually bigger than the stimulus of World War II and the spending that occurred during those years. Don't fight the Fed, don't fight free money, don't fight spending until the bill comes due. The bill won't come due for a while. So that's the big message here. The other reason why the Fed won't raise rates, there's a lot of long-term unemployed Americans that remain off the payrolls, right? So when we look at this chart, the labor force participation rate obviously got hit in March of last year with the shutdowns, has recovered, but we're still well off the lows or off the previous highs. In fact, we're back at 2015 levels when the population was a little bit smaller. And so we need to pay attention to these things, because this is the chart the Fed is looking at. This is the chart that the Fed is saying, why would we raise interest rates when there's so many long-term unemployed Americans out there? We need to help them. We need to get them, we need to make sure the economy is healthy enough so that there's job creation so that these people can get jobs. As an investor, I look at this and I say, and we say, interest rates are going to remain lower for longer. And when that gets priced back into the market, you're going to see a big repricing upward in a lot of the stocks that we own. Real quick here, Tim, do you want to kind of speak to the importance of active management? So just real quick before you delve into that, Tim, a lot of active strategies have underperformed in the month of March. And a lot of it has to do with the fact the index is outperforming. And what we wanted to speak to here is the difference between short-term trading and mega winners, as we call them. So those mega trend stocks. And so Tim, do you want to take it away from here?
Yeah, so one of the things we often talk about is this idea of why would you give money knowingly to both bad and good companies within the index, right? And one of the things that I want to highlight here is the percent of stocks experiencing negative returns, right? You can see on this chart on the left here, 42% across all sectors. And I think this is really the crux of how we look at active management is we just want to be able to avoid, if possible, these bad areas, right? If we can eliminate this section of the market and try to identify, what we call these mega winners, we're doing our job, right? And not just the percent of stocks experiencing negative returns, it's the percent of stocks experiencing relative negative returns, meaning they didn't outperform the index that they're in, right? And that's 66%. And so our job is to try to identify what are these long-term trends that, 5 years from now, 10 years from now, these companies are going to be benefiting from.
Yeah, absolutely. And, it kind of reminds me of the phrase, the Marines have, the few and the proud. Well, it's the few, the proud, and the mega winners. when we look at the actual, I think this middle column right here, ladies and gentlemen, is so important. The percentage of stocks experiencing negative excess return relative to their index. Look at these numbers, 66%. In other words, if we round up to 7, for every 10 stocks that you're buying in the index, 7 are going to underperform the broad index. Why are we concentrating so much money in the 70% of companies that are underperforming? And you may ask yourself, well, how can it be that 70% of companies in an index are underperforming relative to the index when they're the majority? And that's because indexes are market cap weighted, right? So the larger companies that grow more relative to their underperformers are going to have a larger impact on the price of the index versus the vast majority of companies that start to underperform over time. And what we can see here is the percentage of stocks that are defined as mega winners. This is a fancy term for secular growth stocks, are in the low double digits, anywhere from 10 to 17%, overall around 10%. 10% of stocks in the index at the end of the day are leading positive disruptive change, are benefiting from positive long-term secular growth. Now, here's the question, and it's very important for today, for this week's market update for the month of March in general. These 10% of stocks that are defined as mega winners from 1980 to 2020, did they ever suffer stock market corrections? Did they ever suffer corrections in their stock price when the rest of the market did okay? Yes, many, many, many times. And when we meet with clients, when we meet with advisors, the number one regret we often come across from investors is that if I had only held on to Amazon when I bought it in 2005, or Apple or Facebook or Netflix, I wouldn't be speaking to you today. I would have my retirement set for life. And that's because investing in a company long-term is so hard in the stock market, because it tests our wits. It makes us feel insecure when the price goes down, and it has nothing to do with the fundamentals. And so, we had Tim put this chart together. It was a case study of some of the mega trend stocks that led from 2009 to 2020. Amazon, Apple, Google, Facebook, Netflix. All of these are captain obvious stocks when we look at those stocks over the long term. Obviously, these stocks did well. But what did you do as an investor in 2010, in 2012, when we had the European debt crisis? What did you do in 2015 when we had the China growth scare? What did you do in 2018 during the Federal Reserve scare, when they suggested interest rates were going to go up faster than expected? Or during COVID, or during the month of March this year? Did you get shaken out, or did you have, I hate to use the term, did you have diamond hands, right? And, I had to throw that in there just because it's been such a crazy year, and some of these terms that are thrown about. But you know what, if there's anything, it's actually a good lesson for people. When you own good companies, you have to be strong-willed, and especially when you know that the fundamentals are continuing to improve. So what we see here is that Amazon, Google, Apple, Facebook, Netflix, Microsoft, they had drawdowns of greater than 20%, anywhere from 3 to 7 times. Netflix went down 75% at one point. Now, we don't expect any of our stocks to do that this time around, but Netflix went down 75% once. They went down 50% another time, 30% another time. Look at a company like Apple. It went down 45% from peak to trough in 2012 to 2014. 45%. This is a company that was obviously in a smartphone super cycle. What do we hear? What did we hear at the time? Oh, there's no more total addressable market for Apple. They've sold phones to everyone they can find. They missed the bigger picture, though, of the services business, right? Of the margins and the free cash flow and the refresh rates at higher price points for their phones. All of these points are missed because people pay attention to the short-term action of the stock price. And so when we look at the companies that we invest in, we're not investing in COVID stocks. We're not investing in reopening stocks. We're investing in mega trend stocks, in stocks that are leading positive disruptive change, that are going from good to great. The disruption of the modern workplace, that is something we invested in before COVID, during COVID, and will continue to invest in after COVID, right? The digitization of everything in the American economy, the biggest mega trend that's taking place, that's not going to reverse. That's going to continue accelerating as company budgets continue to expand, as people continue to do better, as the economy continues to recover.
Yeah, and one thing I would also like to highlight here is so
Yes.
often we hear from clients, other investors that I missed the trade, I missed the boat on this one.
Yeah.
And you can just see with Amazon, right? You had 5 different times over the course of the past decade to buy Amazon on a 20%
Yeah.
discount, right? These are buying opportunities if you're in it for the long run, right? You might have missed the few month trade, but over the long term, all of these companies have provided, exceptional value.
What a great point, ladies and gentlemen. Every time you had one of these big corrections in each of these individual stocks, 9.9 times out of 10 in the media by commentators, all they were doing is they were writing the obituary of these businesses. But if you had simply just read the quarterly report, jumped on a conference call, done the fundamental research, you would have said it is obvious that things are getting better, not worse. And that's exactly what we do here at LifePro. We go through each of the individual companies. That could be Zoom, that could be Shopify, that could be Peloton, that could be Snap, that could be Intuitive Surgical. We look at these companies and say, what are the fundamentals doing relative to the stock price action? And does it make sense to continue holding this stock, buying more of this stock, or switching into another stock if the business cycle is intact and there is attractive investment opportunities that we're not currently in? And that is how you generate excess return over time. And so that's the message from this week, ladies and gentlemen, is that we have to stay focused despite painful corrections in the stock market. We had it in December, we had it in October, we had a day in November when my firstborn child was born, where it was overnight that Isla was born, and that day our strategy went down 9%. Of all days that could do that, it did it on that day. And so I had to punch out a message out to clients and investors, and sure enough, we had the biggest 1 month rally as a firm in the month of November, and that was with the 9% drawdown at the beginning of the month. And so it's so important not to get caught up in this day to day. Listen, my accounts have gotten hit over the last 30 days. Tim's have gotten hit. Our family's accounts have come down in value. But the important message is not the 30 days, but going all the way back to this chart. And that is the broader long-term trend. And if we can stay focused on those broader long-term trends, we're going to do a good job over time. I'm convinced of that, of making our clients, our advisors, our investors a whole lot of money if we stay focused on that and we do our research and we stay focused on what we're good at, which is identifying mega trends in the economy, the companies leading the charge, and making sure that they stay healthy and in a position of leadership. So, Tim, as usual, I just want to really thank you for all the work that you've been doing, communicating with advisors and clients. And, not most importantly, but just as importantly, I want to thank all of our clients and advisors. Whether it was March of last year, whether it was during the contentious US election period, or whether it's during this past month, every time we've had these stock market corrections, we've had a good chance to have these conversations, learn a little bit more about what it takes to be a successful investor, and allow ourselves to be coached, whether it's us coaching clients and advisors, or it's advisors and clients coaching us on what they're going through and what they're feeling and what makes them stay awake at night. And a lot of times it's not just because the price is going down, they're worried about other things. And if there are other things you're worried about, give us a call and we can walk through and navigate how to adjust for that period of uncertainty, not just in the market, but really at your household level, because that's what matters more than anything. We're reminded of that during this health scare period over the last year. And we just really want to thank everyone for their business, and rest assured that every single day we come into the office and we want to say, how can we create more value for our investors, our advisor partners, their clients, and just really make sure that over a year from now, we can go back and say, hey, this was, again, following that 100% track record, a great time to invest and create value for everyone involved. So thank you again. Thank you to our advisors. Thank you to their clients and to our investors. And if you have any questions, please reach out to your advisor. They are standing by the phone, ready to help. They're reaching out to you right now. And if you cannot reach your advisor, feel free to reach out to us directly. We're here to help, and have a fantastic week. Thank you, everyone.